Okay, so 3 days of order flow. Got a lot of emails from you guys last night. Appears to me that everybody kind of had a little bit of a moment yesterday where they started understanding how to really take ownership of a position and make some decisions based on information rather than on emotion. And really glad to hear that. And if you had trouble with the first 3 days and you didn't get there and you didn't have a kind of an eye-opener yesterday, then we need to talk and figure out where we missed something, because we're moving on today. We've spent 3 days on order flow, and what you should get a sense of by now is that it's the process of reading the order flow has everything to do with what's right in front of you right now, whether that's making sure that you can justify an entry, locating a stop, getting a sense of the direction, who's in control, who's profitable, who's upside down, looking for targets, etc. But in the scope of trading this effectively, I would say that by itself you've learned very little. Okay? And so that ought to get you ready to pay attention today. Because while looking at a very micro side of the market can be effective for a short-term entry, in the long run what we're trying to do is position ourselves with the larger trader. Okay, we want to be involved in the market when there's the most opportunity and the least risk. And in order to do that, we need to take a step back from the tick-by-tick order flow and get a sense of where a larger time frame trader is likely to be involved in the market. As we said day one, the beautiful thing about this market is that there's a lot of volume, but the downside of this instrument, if there is one, is that trying to interpret the psychology is very difficult, because you have so many people engaging the market for so many different reasons, whether that's somebody hedging or trading against a basket of stocks, or looking for swing trades, or whatever it may be. Okay, so we have to kind of be able to put ourselves in the mindset that not everybody has the same objective as us. And if psychologically speaking we want to be engaging the market where a larger trader might be looking for something, he's probably at most points not looking for a point or a matter of ticks, with the exception of obviously a market maker that's specifically doing that. Okay, so if that's the case, then I want to have a way to value the market. And today we're going to talk about what I call chart structure. Okay? To me, just being able to look at where the market is traded, the responses that have taken place at different price levels, is a very simple way to come up with valuation for the market at any given time. Whether that's targets above you or targets below you, it should usually be a combination of both. Really, the only thing that I'm interested in is where is the market trying to go and how good of a job is it doing getting there, right? If I can locate areas where I think the market is trying to go, then I can use the order flow to find out how good of a job it's doing getting there. Right? And if I combine all of the things that I've learned over the last 3 days with valuations in the market where I would expect there to be a reaction, okay, meaning trading up to a level where we would expect either the responsive seller to come in or the buyer to initiate enough trade to break out, or the seller carrying the market down until the responsive buyer comes in, or the seller initiates enough trade to break through those levels. So as you probably noticed, I start every day with a game plan. Okay, and essentially what I'm doing is looking for key market transitions. I locate those key levels that I think are going to be important. I then am also looking at volume distributions, which we'll touch on a little bit today. I want to give you a little primer on that. And implementing range analysis concepts. Okay, and all of these things together give me a pretty good sense of where larger traders might be valuing the market as too cheap or too expensive. Okay? At that point, I have the ability to integrate other technical analysis should I choose to. All right? I can look at things that, for the most part, by themselves may really not be all that effective. But if I can combine those with something, then everything will make a little bit more sense for why something like a pivot point derived from the high, low, close divided by 3 might be important, or a Fibonacci retracement or expansion level, or moving averages, or whatever. You know, just because the math says the market should stop there, or because that's what we saw the last time we were there was a response or initiated trade. So we'll talk a little bit about integrating the things that you might already utilize. And to me, all this really is, if you think about it, like either when you were a child or working with your children, if you've got a puzzle that has 1,000 pieces, and you take that puzzle and you throw it on the floor, and you throw away the box, and you say, all right, let's build this puzzle. It's going to be extremely difficult to interpret what all these little tiny pieces mean. But if you have the cover of the box and you're looking at the picture, you can start to sort things out by color and by shape and how they fit together, and you can make something out of it. And then suddenly that picture will unfold for you, right? Because you've got a starting point. Well, trading's very much the same way, and if you don't have a starting point each day where you've got that image in mind, and granted, you're not always going to be correct. We come up with a lot of potential unfoldings each day that don't happen. Okay? But we know how to react when the market gets where we're looking for. We know what we're looking for ahead of time. And what that does is it puts you in a great place as a trader to just simply respond to activity. Okay? We talk a lot about responsive buyers and sellers, and sellers initiating trade, and we talk about how trade's classified and the fact that somebody's making a concession and giving up the better price, right? Well, I'm a responsive trader by nature. I'm going to come up with my analysis ahead of time and respond to how the market activity reacts at those levels. Okay? The last thing we're going to go through today is a little primer on our algorithmic pivots. I've had a lot of questions the last couple of days about the pivots and what they mean and things like that. Obviously, they're not high, low, close divided by 3, add the support, subtract the resistance. All that straight math stuff to me is too arbitrary. That's why they work about 50% of the time. Okay? So over the years, I developed a process for coming up with logical ranges and things like that. And we include that in the software for you so that you've got some reference points. But by themselves, they don't provide you with anything more than a moving average would. And we're going to have to learn how to read the chart structure so that we can implement that technical aspect of it as well. And the combination of the two can provide you very good opportunity. When we start talking about chart structure, the most important thing is that you've got to understand really how the market looks, regardless of your concept of time frame or anything else. It doesn't matter if you're looking at a daily chart, a 60-minute chart, a 5-minute chart, or a 2-minute chart. For whatever time frame you're looking at, the market will always have 2 primary phases. Most people think of trend immediately. Okay? The market's trending, and we had some discussion earlier this week about, well, what do we call trend and what do we call consolidation? A trend indicates that there's a range expansion, okay? Something that is expanding or breaking down beyond established levels of support or resistance, okay? And consolidation being the other phase where we have a price contraction that's bound by those established levels of support or resistance. Right? Now, the first day I told you that these are words I didn't want you using anymore. Right? Made a big point of that I wanted you to get beyond that, and today we're going to discuss why. Okay? When I'm interested in what phase the market's in, I don't so much care whether we're consolidating or whether we are trending. Doesn't really matter to me. The important thing to me is identifying the transition between those two phases. Okay, when we have a shift in the phase, that means that there is new volume in the order flow, and it's typically important. Okay, that's the most important thing, is the transition between these phases. All right? So in terms of buyers coming into the market, buyers can respond and form or confirm support, right? Responsive buying would indicate a level of support. Or buyers can initiate enough trade to expand through resistance, right? So if we look at an established range, buyers coming in at the low would form or confirm that support, and buyers trading through resistance would indicate a breakout. Sellers would either respond to form or confirm resistance in consolidation, or they'll initiate enough trade to expand through support in a breakdown. In this case, we're looking at several days. Okay, this is a period in July that's maybe, what, 10 days of trade? Okay, and so within just this large format, we can see areas where the market has consolidated and areas where the market has trended. In other words, beginning a trend and then starting to consolidate and then breaking out of that range, so back into a trend and into consolidation. Well, it's easy to use words like that and say things like support and resistance and everything else, but what we're learning about how volume comes into the market is that what we could actually say is that when we were trading this range below, the buyers initiated enough trade to put us into that trend, right? To put us into an expansion. And as they traded back down, there was then responsive buying that held us back up above where the buyers initiated trade. And as we traded across, there was responsive selling that halted the upward movement of the market. And as we traded back across that range, there was responsive buying that came in again and confirmed that range of consolidation. Again, confirming with responsive selling, and eventually seeing the buyer initiate enough trade to break that range and expand the range into a new trading area. We see responsive selling, responsive buying, beginning to establish a new range with more responsive selling, and more responsive selling and more responsive buying. Okay, so do I need to consider this as support or resistance, or do I understand what's taken place here in the market? Do I understand what took place when we reached these levels? You know, the fundamental aspect of this does not need to be you staring at the order flow on your chart from 3 weeks ago. You ought to be able to understand when you look at any time frame chart, with or without the volume in there, that what takes place in these transitions, whether it be the market trending up and then stopping and starting into consolidation. Okay, well that would be responsive selling took place, followed by responsive buying to hold the range. Right? Or when consolidation breaks into trend. In this case, a breakout would indicate buyers initiating trade, right? So anytime that we've got a transition in those phases, we can infer that there was a valuation there. Okay? Either the buyers felt that it was simply too cheap and took advantage of it and bought through. Sellers felt that the price was too expensive and was a good opportunity to short or to take profit as a long. So there's a lot of different ways that we can look at the chart and locate areas where there has been previous valuation taking shape. Okay? Much more so than saying support or resistance or a trend line. Right? We can understand by what we know about the order flow and how the market works as a whole, understanding the relationship of supply and demand and the inability for the seller to carry the market any lower because the overwhelming supply that existed there. and then the buyer initiating trade. Right? We can start to look at the chart and understand what's happened the last time we were at places. So we can do things like finding previous reversal points. Okay? This would be a transition in phases of trend essentially to counter trend. Right? If we see the market reverse, we're essentially, for whatever time frame we want to break it down into, that phase has gone directly from one direction to the other. Right? Which would indicate what? That the buyer has met responsive selling. Right? If the buyers are driving the market higher, they meet responsive selling. Okay? But what else would they have to do? We can't just have the buyer meet the responsive seller to have it go from one trend to another, can we? We'd also have to have the sellers then initiate trade. Right? We need those market sellers to come in and start hitting the bid. Right? And if we're moving lower in a downward trend, a downward expansion of the range, and we see the seller meet the responsive buyer, that's obviously going to hold the market up. But in order to reverse, we'd also have to then see buyers initiate trade, right? So in a reversal, we can imagine that that's what's taken place. We can look to those areas on a chart and say, yeah, the last time that we were trending up and we started to then go directly into a downtrend was right here. This looks like a good place for me to look for a trade, right? Or vice versa. So, look for reversals. Look for exhaustion points. Right? That would indicate trend moving into a phase of consolidation. The market's driving higher and suddenly we stop dead and start to consolidate. That would indicate what? That the buyers met the responsive seller, right? Or if we're trending lower and we've broken down and then suddenly we see the responsive buyer come in and stop the market, would exhaust that downward expansion. We can also look to our charts in previous trading and find where we broke out or broke down from previous ranges. Right? That would indicate that a period of consolidation broke out into a trend. So if we were consolidating and broke out, we would be looking for, we would assume that the buyers initiated trade there, right? Just as we look for that all day long, what difference would it make if it happened 10 minutes ago or 10 days ago? If we broke through a previous range, there's a valuation that took place there. The buyers initiated enough trade there. That's an area that we're going to key in on. In the case of a breakdown, we'd be looking at areas where we see the seller initiated enough trade to break from consolidation into a downtrend. Okay? So a lot of points here, but let's talk about what we'd really be looking for. If we look on a chart and we see a reversal where we were trading up and then the market reversed down, okay? The buyer meets the responsive seller and the seller then initiates trade. What would we be looking for? What would we be looking for if we were to now trade back up to an area where we had a reversal? Very good. We'd want to short any responsive selling pattern, and if we saw the buyer initiate trade, we'd go long, right? It's a previous valuation. The last time we were here, the buyers were unable to drive through it and the sellers came in. We have to assume for the purposes of argument that not everybody's out of their position. Right? It's like what I said yesterday. If you gave a 5-year-old $1 million and explained the very basics of how to come up with or how people make money in the market, and you say, I'm going to give you $1 million to short, and he'd say, well, the last time somebody sold was all the way up here, that's where I'd sell. A 5-year-old gets it. For some reason we don't. Right? So if we see a topside reversal, we're looking to short responsive selling, and if the buyers initiate trade through it, we're looking to go long. Right? What if we see the seller meet the responsive buyer and the buyer initiate trade? What if we see it the other way around? A downtrend that turns into an uptrend. The next time we get down there, what are we looking for? Right. We're gonna go long if we see responsive buying, and we're gonna go short if we see sellers initiate trade. How about areas where we see a strong trend that's now turned into consolidation? What would we do at the top of a range of consolidation? We'd look to short responsive selling, and if it broke out of the consolidation, we'd look to go long with buyers initiating trade. Right, very good. What about the bottom of consolidation where we've seen the responsive buyer come in? When we return to the lows of consolidation, what are we looking for? What kind of patterns? Very good. Responsive buying or sellers initiating trade. What about when we see a range, a big range, and we've seen it a lot lately, where we trade in a range for 5 days and then we break out and we trade up in a higher area for a while, and then gradually we end up trading back down to where the buyers initiated trade. What would we be looking for when we see that it's a level where previously the buyers initiated trade? Correct. We'd be looking to go long off of any responsive buying pattern, or we would look to short if the sellers initiate enough trade. And what about when the sellers break down a range? And they go from consolidating to a breakdown. When we return to that, what would we be looking for? No. If the sellers have broken down through consolidation into a breakdown, we would be returning to that looking for responsive selling to short, or buyers initiating enough trade through that level to go long. We're going to do some picture examples here so you guys know what I'm talking about. I know it's easy to get confused, but think about it. If we see a previous breakdown, when we return to that level, we want to short it if there's responsive selling, and if the buyers buy through it, we want to get long. Okay, so look at it this way. If we've got a transition from trend to trend, we need to establish first that there would be a trend, right? So in this case, if we look at this and say, well, there was an established range here, and then we traded up and created a new trading range, right? Now there's no time frame on this chart, there's no prices, but based on the action right there in front of you, could everybody agree that we had a previous range that we expanded and now we have traded up to a new high? We've created a new trading range. Agree or disagree? Just from the orange to the blue. Okay? All right, so we don't know what time frame this is, but we could all agree that, sure, a new trading range, then it's obviously, in some regard, trending up, right? Well, we know that to go from trend to trend, we basically would need the buyer to meet the responsive seller, and we would also need the seller to initiate trade in order to reverse the market, right? It's not good enough just for the responsive seller to come in. We need the seller to then be active. Okay? Typically when we've got a trend to counter trend reversal, there's two influxes of volume there, right? If we look at that and think about what's taken place, we had the responsive seller that came in at the very top of this, and then in order to drive the market, we had the seller then also initiating trade. Okay? So very often when we look at a major reversal, one of the key things that we'll tune into is the fact that probably the next time that we trade up to this level, we'll actually get a responsive sell that will come in before the previous high. Okay, just a little bit inside of it. Why? Because we've not only had the responsive seller last time, but we had a lot of shorts that initiated trade right after that. So just slightly below. Okay? So very often what we're looking for when we return to a reversal like this is to see that responsive selling effort come in just before it. Just before it. Okay? It's a good way for us to focus on things when we look at a chart. We can, we don't have the order flow chart in front of us. We don't know specifically what happened there. But after 3 days of learning about this, can't we make some assumptions here? There were some buyers that got stuck at the high. They got flipped upside down. More sellers initiated trade. That's how we broke the market down. I mean, we know what it takes, right? So that's the kind of thing that we're looking for when we look for chart structure. Okay, well, this is a way for you to value the market, Mike. I'm not going to make assumptions about what happened here the first time. Okay. Obviously, I hope that you took a trade here. But what we're talking about is how in the morning do I come up and say, where am I looking for trade? Okay. And the only thing that I can do is try and establish whether or not we're trading in the same range we've been trading in, or have we broken through that? Right? Are we in a state of consolidation, or are we in a state of trend? All right, so hopefully you took this short. I sure hope you did. But if not, I wanted you very aware the next time we came up here that this is where you ought to be looking for responsive selling, or this is where we're looking for the buyer to initiate enough trade to trade through and create a new range. So when we talk about the transition where we have a trend into consolidation, now notice this is the same chart. Okay? Just a little more information. We don't know the time frame. We don't know if we're looking at a 60-minute chart or a 5-minute chart or a 100-tick chart. No clue. Okay? But we know that if we have a previous range and we start trading above it and creating a new range, then we're having a range expansion at least. So if you can't call that a trend, I don't know what you can. Okay? We're no longer trading in the range. We've now expanded the range. We've made a new high. Okay? And what happens when we make the new high? We see a responsive seller come in. And as we trade back down across that range, what happens? We have a responsive buyer come in. All right, so what we've now done is seen that regardless of the point spread or the time frame or anything else, we can say that we have begun to trade in a range. All right? We have bound a range where you would normally say there is resistance at the high and support at the low. We know that there was a responsive seller above and a responsive buyer below that has held this range. We're trading within this range. Right? Consolidating. And what we're looking for when we establish a range like that is to trade back to either where the responsive buyer came in or the responsive seller came in. And that's where we would be looking for, in this case, responsive selling. And obviously, if the buyer initiated enough trade, getting long. Probably the easiest thing for most people to recognize is when we do have consolidation that then breaks out or breaks down. In this case, our same range, right? And look at this. This chart that we've been talking about, I said could be a 5-minute chart, a 60-minute chart, a daily chart, who knows? Okay? 60-minute chart. Several days of trade created a giant range. Not a 5-minute chart, but several days. Expanding a range, trading within the range, range bound, range bound, range bound. We've been doing this a lot lately, haven't we? And this is from July. Almost looks like the last couple of days. But what happens eventually is the buyers initiate enough trade to trade through the last place that we see the responsive seller. Okay? That's going to be a key point for us. I don't know if we're going to come back to it today or tomorrow or the next day or 5 days from now. But I know that trading back into that range is a whole different world. and that the buyers initiated enough trade to get us out of it. So I want to pay attention to that. There was a valuation that took place when the buyers said, you know what, it's cheap enough, we're going to buy through it. At that point, they valued the market too cheap at that level and drove through it. And we need to pay attention to it the next time we come back there. Just like you would in the order flow in the short term. Okay, so I'm going to give you a little primer on volume profile. I want to be very clear. I have no expectation that this is something you utilize. I don't provide you with volume profiling software or anything else. I don't own the one that I use. If you're interested in it, I highly recommend it, but I want to preface that with it is not something that you will learn in a 5-day class. Okay? It will take you some time to understand. I'm not really familiar with any books or anything that I can direct you to. It's something that I've learned over time with a little bit of education and market profile. They're very similar, but because everything that I do is trading from volume, it complements what I do very, very well. So I'm going to introduce you to it. I'm going to introduce you to the concepts. And if it's something that you want to pursue, obviously we do some work in here with the apprentice students on understanding it. Every day I'm pretty much talking about it. So it's something that you can start to pick up the pieces from. Don't attack this on Monday. Okay? Right now we're trying to get one big giant thing under your belt and get you very familiar with the order flow concepts and everything else. Once you feel that you're confident in your comprehension of order flow, and this is something that you want to begin to study, by all means, that's when I want you to do it. But I am going to give you a little primer on it. Essentially, when we look at trading ranges, the high and the low, and the fact that we've traded back somewhere into the middle of that, an informed trader will look at that range and say there was opportunity at specific levels and a tremendous amount of risk at others. Okay? And volume profile is a way of studying the way that volume came in so that we can easily define those areas of risk and opportunity. Okay? When we talk about two-sided risk, what we mean is that essentially we will have opportunity on the edges of the range where very few people were able to take advantage of it. Okay? Very few people took advantage of the short from the high or the long from the low. All right? So where we see the responsive buyer and seller in a range, very few people are taking advantage of that in comparison to the bulk of the trade that takes place. The highest concentration of volume is typically in the middle of a range somewhere where both buyers and sellers find some sort of merit. Right? I think I need to go long, you think you need to go short, a lot of trades exchanged. And the only people who make money in the middle of a range are the market makers. Right? Because what they're looking for is for you to constantly be in jeopardy, for you to constantly be upside down. A market maker is basically somebody who's facilitating trade. Okay? Often they're paid by the exchange simply to trade. Okay? They're not looking for much out of the market, but they're trading in bulk. Ticks here and there. Okay? And when you get into a trade because your indicators have crossed over, and you get in right in the middle of a range, not at the low where the smart money was, not at the high where the smart money was, but right in the middle. Imagine you're in a 3-point range. You're in the middle of it. You've got a 1.5-point stop. All they have to do is push the market out to the edge. Doesn't have to go on a run, just to the edge, and you're going to get stopped out. Right? So there's a lot of risk involved in trading in the middle of ranges. And what we want to do is use a tool to tell us where the majority of trade has taken place. Now this can be a little counterintuitive after just learning about order flow analysis, because what we're going to talk about is the fact that where the lowest volume is often the highest opportunity, and where the largest volume ends up being the highest risk. And that's a little bit backwards for what we're looking at when we talk about entries, because we're trying to trade up against volume clusters. So bear with me. I know it can be a little bit confusing and perhaps a little bit much. And if you already feel like your sponge is full, put your fingers in your ear and ignore this for the next couple of minutes. When we look at a profile, essentially what we're trying to do is come up with a normal distribution of volume. And if you're not familiar with the term normal distribution, think back to when you were in grade school. Okay? If your teacher ever graded on a curve, that's exactly what normal distribution means. It means that we're interested in where the bulk of something took place, and kind of putting the extremes out to the edges. All right. So think of a sideways bell curve, and all of these little lines along the side, this histogram, representing volume. Okay. And so what it does is it tells us, very, I guess, scientifically or mathematically, where the majority of trade took place, and from that, if we do have a nice normal distribution, in other words, something that looks like a rounded bell curve, then we can see where there's opportunity and where there's risk. Now, it obviously doesn't take a genius to do this, without some tool. Just take a look at where trade took place and tell me, in hindsight, where there was opportunity and where there was risk. Obviously, every time we traded out to the edges of this range, there was opportunity for responsive sellers. And any time we were in the middle of this range, could you have made some money long or short from the middle? In some places. But would you have gotten upside down quite a lot, regardless whether you were long or short? Right? We've all done this. We've all been the guys who are following a trend-following indicator, and the day consolidates. And every time you get long, the market flips back over and trades down. And every time you get short, the market flips back over and trades up. Okay? A lot of risk involved in trading where the bulk of traders trade. Now, why do you think that is? I mean, come on, we've already established this week that we know the stats. We know that 80 or 90% of the traders out there lose money. So why do I want to trade where they are? All right? Why do I want to trade where they are? The reason that there's opportunity on the outskirts, and I know the question, well, what if it just runs the other way? Okay, well, at least I know what my stop limitations are. If I take a short from the high of this, how far am I going to let it go before I decide that it's not a very good idea to be short? If I go long from the low of this, how far am I going to let the market go before I decide that's not a very good idea either? Right? It's not the same as going long from the middle of this range and saying, well, the last time we did this, we traded out 4 points lower, and the last time we did it the other way, 4 points higher. So am I going to use a 5-point stop so that I can trade from the middle, or am I going to use a 1-point stop so that I can trade from the edge? Okay? Opportunity versus risk. Much higher risk to be screwing around in the middle of a range where there's two-sided trade, back and forth, buyers and sellers, market maker participating, right? And so when we look at this, we can consider it kind of like an over and under when we see a volume distribution, right? As we trade up to the top of a distribution and we're on the outer edges, we're looking for responsive selling. And if we see a responsive selling pattern, fantastic. But if we see buyers initiating trade, we understand to be on the other side of it. And if we trade down to the bottom where we see opportunity, if there's a responsive buying pattern, then there's opportunity. And if the sellers initiate enough trade to trade through that, then we need to be on the other side of it as well. Now, an example where we have basically just straight consolidation. And obviously there's going to be times where we have multiple ranges. Right? So in this case, I'm profiling several days here where we've had an upper trading range and we've had a lower trading range. Okay? And it's very obvious, based on the last slide that we looked at, that we have an area here where there's opportunity and risk. Right? There's opportunity and risk here. Okay? We should also be aware that there's opportunity and risk that exists here. This is a previous trading range down here. Right? And because these two establish those areas of opportunity and risk, we can also see an area where there's virtually no trade at all, which essentially tells us that there's high risk here for once we break down below the first distribution, that it should probably trade all the way down to the next distribution. So it doesn't do me any good to be putting on trades in the middle of that unless I have the opportunity to short through it. So the process of profiling really comes down to being able to identify the right period of time to establish a range and figure out where the majority of trade has taken place. It doesn't do us any good to just put on an indicator that says, I'm going to look at today and profile today. Because obviously if we create a range, then that's going to provide us with a lot of information. But if we don't have a normal distribution, what good's it going to do? What if we're just breaking out or breaking down? Well, we may be able to look at portions of the day, or we may be able to look at a larger range to figure out where we might be trading across to. So profiling is something that's very dynamic. It requires you to constantly be making adjustments. Every day I start out and I have a profile of the current session, I have a profile of the Globex session, I have a profile of yesterday and today's session, and I have a profile that's totally dynamic that I have to adjust every single day. Where I say, okay, did we break out yesterday? How does today's range compare to the last 5 days? So it's not something that's easy and fits into a box very well, but it tells us an awful lot about where trade has taken place and where there's opportunity, and it can be an excellent confirmation tool when I'm looking at things and saying, do I want to approach anything in this area? Range projection analysis. We're going to talk a lot about this. The first thing that I like to do when I'm looking at trade is I come up with averages. Okay? And it's not good enough for me to take the average daily range because every day is a little different. Some days we break out, break down, some days we consolidate, some days we have reversals. It doesn't really do me much good to look at it that way. But what I know are the times of day where I have expectations of certain things. And the reason is because there are different participants in the market that are active. The first hour of the day from the opening bell will typically produce a 10-point range. It obviously hasn't the last couple of days, but typically that's where we expect to see the majority of trade taking place. The majority of market participants are there when the bell goes off in the morning. Okay? That's when the pit is the most full. And after the first hour of trade, you have a lot of people who have made a lot of money that walk away with money in their pocket. It's like the old, the gambler that goes to Vegas and sits down at the blackjack table and gets so excited because he makes a couple of $100. And he's like, man, I'm really smoking it. And somebody says, hey, why don't you get up and leave? You know how many people leave Vegas with money? And yeah, but I'm really doing it, right? I'm really doing a great job. And what happens? Doesn't take much time for the tables to turn, right? Well, most successful traders engage the market when there's the most opportunity and the most traders and the most volume and the most volatility. And when they've taken money from all of the people who are failing at this, they walk away. It's no different than a successful gambler walking away, right? Walk away. We've done what we needed to do today. Why would we put all of this profit at risk in a less advantageous time? So typically what we will see is very intense trade for the first hour, and it will usually yield 10 points. Now notice at the top line of this it says dynamic, test yourself. Don't take my word for this, and don't think that this is some static number that's always going to exist. And just the amount of time that I've been teaching, which is about 9 years now, we've seen the average ranges of the market change dramatically. Okay? We used to assume that every day was the total range for the day would be about 10 points. Okay? And usually about 7 points in the first hour. And then we've gone into a period where we see 20, 25-point averages. Okay? 17. It moves around quite a lot. So it's something that you need to constantly be paying attention to. What are we averaging when we trade? You know, the reason I want to know this is because if I have an expectation of a target when I get into a trade in the morning, I need it to line up with something that makes sense. Does it make sense for me to have a 30-point target at 11 o'clock in the afternoon? No, it doesn't. Right? It doesn't make any sense because statistically speaking, we don't move much in the afternoon. Okay? So this is how I break the day down. I look at the first hour, I look at the second hour and a half, I look at the 2 hours that I would call lunch, which essentially starts at New York noon and runs to 1 o'clock Chicago time or 2 o'clock New York time. Okay? So this is typically a time when we don't see more than about 6 points total, regardless of how big the day is. Now there are exceptions. There are going to be days where we have noon housing reports. There are going to be days where we have some economic event, or God forbid Bernanke or Obama get on television and talk about how smart they are. Either one of them screw up the market every day. Then we're going to have a period in the afternoon typically where we will see another large activity. Now this doesn't mean that from 8:30 to 9:30 the market's going to move up 10 points, and then from 9:30 to 11 it's going to move up another 10 points, and then we're not going to end up with a 36-point day. What I mean by this is that we may very well see a range of 10 points in the first hour where we trade back into it 5 points. And then in the second hour and a half we expand that range by 5 points, maybe giving us a total of a 15-point range, but typically in that second hour and a half we will see that much activity. Now, starting last December, it's died off like nothing I've ever seen. We have trade from 8:30 to 9:30 or 8:30 to 9 sometimes, and then we're holding more of like this 6-point range, 5 or 6 point range. Okay? And the last couple of days have even been worse than that, and I think we're all pretty in tune with it, right? Now, the other thing that I would note on this is that while it says 1 o'clock to 3:15, and all of this is Central Time, guys. I do everything in Central Time. That's where the exchange is located, and that's where I'm located, so make your own adjustments. It says 1 o'clock to 3:15, meaning after lunch to the close. But what we've seen recently, and I mean from about last summer till current, is that there's almost no afternoon activity. We used to see a huge influx of traders coming back to the pit, driving the market for about 45 minutes, and then calling it quits again. But instead, what we're seeing now is that if that's going to take place, it's basically an influx at 2:30 or 2:45 in the afternoon, and it lasts about 10 minutes. Sorry, wife's harassing. Okay, so what this means is that not only can we use things like this where we come up with these averages and we pay attention to this stuff, and I'm a data miner. I love it. I love to look at information and I love to draw patterns out of it. That's what I love to do. Not everybody loves to do that, okay? Not everybody does. But I love to have statistics on my side. And what I can do is look at the way that the morning has developed, and I can understand whether I'm in for, whether my targets are realistic. If I'm telling you that I want to see 42 today, and by 11 o'clock we're not even able to break out of the 35.50, is it realistic? Probably not. It's certainly not going to happen from 11 to 1, so I'm not going to worry myself with it. And if I do get into trades in the middle of the afternoon, I look at how much ground we've actually covered, and it may be that we've already traded basically 4 points, and even though there's a breakdown that seems to be forming, I'm going to give myself about a 2-point target on it, because I just don't expect the market to move that much during lunch, because it just doesn't ever do it, right? So it's a process of constantly making adjustments throughout the day based on things that you're used to seeing and having some sense in that. Another range that we look at every day is whether or not we're having some sort of gap at the open from settlement. Now, a lot of people don't know specifically what this means, so I'm going to go through it, okay? At the close of business each day, this market is closed for 15 minutes. That's it. It trades basically 24 hours a day. And every day at 3:15 the market closes for 15 minutes. And in that 15 minutes there is a settlement process that goes on for all of the multiple million contracts that have taken place. Everyone's accounted for, they're sent to the clearing houses, everybody's accounts are settled, make sure that everything is kosher, and what takes place is that usually the actual close or last trade that's counted for the day is not exactly where the close was. It's usually a tick or two off. Oh, these people are driving me crazy. It's usually a tick or two off. And so what we'll look for is the settlement price. Where was the last trade of the day? Where was the market driven to yesterday? Well, what was the response at the end of the day? Did we drive up to some price level, down to some price level? Where was there no more trade at the end of the day? Okay? And then from that point, 15 minutes later, the market's going to open again. Now sometimes there's a true gap, meaning that the market will open 15 minutes later and it'll be 2 points higher than it was at the close. In other words, the first bid and ask that come in of the new session are above or below where that settlement price was. So there can be a true gap where there's actually no trade has taken place in a series of prices. Okay? Now that's very important because very often those gaps will be traded back to very quickly, right? In the night session, yes. Okay? So, and you can call it the night session, but I mean at 3:30 in the afternoon. Right? So 3:30 in the afternoon is tomorrow in terms of the trading. Okay? And if there's a gap there, then that's very important. But also, and almost more importantly than that, because it just doesn't happen very much anymore, at least I don't trade at 11 o'clock at night anymore, so I don't really pay attention to it. But the difference between that settlement price and where we open the cash market the next day at 8:30 in the morning can also have a gap. And there are a lot of people who are only looking at charts that run from 8:30 to 3:15. Okay? And so if you can imagine that you didn't see all of the 24-hour data come through, you'd see yesterday's close at one price, and you'd see this morning's open at another one. And there might very well be a gap between that, and almost always there will be. Okay? So we can draw a lot of information, statistically speaking, from how we open in relationship to how we closed yesterday. If we open very close to the previous day's settlement, basically within about 2 points, we can expect that there's going to be a very slow open. We saw this on Tuesday, I think, where there's just not much trade going on. Nobody's really driving the market one way or the other. We just kind of open. And a little bit up, a little bit down, crisscross across settlement. Okay? But typically if we open up somewhere from 3 to 6 points away from settlement, we'll have a very quick drive back to it. And we will either challenge settlement, meaning we will either trade through it and see buyers initiate trade if settlement was above us, or sellers initiate trade if settlement was below us, or we'll reject it. Meaning if settlement's below us, we'll trade down to it and see the responsive buyer come in. Okay? Or we'll trade up to it and see the responsive seller come in. Anybody remember what happened this morning? Our short was right off of settlement, wasn't it? Made a lot of money this morning trading off settlement. Right? We opened about 3 points from settlement, traded right up to settlement, and saw the responsive seller come in, didn't we? Took a little while to develop, but Mike, you called it. Double top at settlement. Okay, so when we open, we want to have some concept of how far we are, because we can draw some conclusions. All right. If we open up, let's say that we have a huge overnight session and we've driven through settlement and more than 10 points away, more than an average range away from settlement, the likelihood of us coming back to settlement is very, very slim. Typically indicates that we will be in a trend day, okay, or a range expansion day. All right. So if we open up 10 points above settlement or 10 points below settlement, we don't really have any opening ideas that we're going to come back to those levels. It's a rule of thumb, guys, rule of thumb. All right. It's just a way for us to start the association in the morning of what we need to be looking for. The other thing that we need to be aware of, and again, this is something that is dynamic and you'll have to test it for yourself, but typically an average directional move is about 10 points. The market moves about 10 points at a time, and then we'll see some sort of a pullback or a reversal. All right? So we can use that number in association with things like, well, we had responsive selling 2 days ago about 10 points from the current low that we've put in. So if we trade up to that level, it's not only where the responsive seller came in, but it's also probably where the buyer is going to begin to exhaust and take profit. Okay? So we'll very often throughout the day just look at things and say, hey, the low right now is 27, maybe we'll trade up to 37, or vice versa. So just keep in mind that an average strong move in the market is about 10 points. Now, beyond that, we can also start coming up with ways to estimate the range for the day. This is a fairly complex process, and I actually taught a class over Christmas in it, detailing all of the math and basis for it. Okay, so I'm gonna get you through this, and if you're interested in really learning how to put this together and do the work yourself, I can work with you on it, and there's a video on it now in the apprentice section. Essentially what we start off with is the idea that we can classify each day. All right? Each day that comes through. At the end of the session we can say today was an outside day, an inside day, a narrow range, the narrowest in 4, a combination of that. It was wider than the previous day, it was wider than the previous 4 days, it was wider than the previous 7 days. Okay, Eric. All right. So it's a classification process, and I didn't invent it. Okay, this is not my invention of how to classify stuff. But we can look at what took place and compare it to the previous day and say, yes, today was a larger range than the previous day, okay? Or today was a smaller day than the previous day. And by doing that, we can then establish a classification for them where we can put all of the days that were wider than the previous day in a batch, and all of the days that were smaller than the previous 7 days in a batch, and all of the days that were inside days in a batch, which simply means if you have an outside day, you would be looking at a day where compared to yesterday, today you have a higher high and a lower low, meaning the range is outside of the previous day. Or an inside day where compared to the previous day you have a lower high and a higher low, right? The range falling inside the previous day's range. So by looking at all of this and drawing those comparisons and saying, all right, well, what happens the next day? On average, after an outside day, what do we see the next day? Right? And we can start to compile that information and say, all right, well, I know what the probabilities are. All right? And an example here, outside day, 55% of the time we see the market consolidate the next day. Okay, well, 55% is not all that great. Maybe it's going to consolidate, maybe it's going to expand, maybe we'll have a duplicate range. All right? Doesn't do a whole lot for me. But when I start looking at things like inside days, where 80% of the time the next day we have a range expansion, or when we have the narrowest range in the last 4 sessions, 81% of the time we have an expansion, or when we have a combination of inside days and the narrowest range, then we have a 91% chance that there's going to be an expansion. Okay, 91%, that means almost every time that we have a day like that, the next day is a big trending day. I want to know that. I want to be ready for it because it's going to help me with my targets, right? My expectation in the morning Am I looking for small little trades in consolidation, or am I looking for this thing to run? And I'm not always going to be right, because it's not a certainty, it's a probability. But when I see things that are 93% of the time, 96% of the time, 94% of the time, I want to pay attention to it. Okay? So then the question becomes, rather than giving it a percentage and just saying, well, that's what I might expect, what can we gain from this? How can we draw a true range estimation from this? And we can do that by saying, look, after an inside day, if we expect that 80% of the time it's going to expand after that, this is the chart I wanted to show you, Jonathan. Yeah, this is the one. After an inside day, if we know that 80% of the time we're going to have an expansion of the range, well, I can do one of two things. I can add up all the ranges after an inside day that were an expansion, and I can divide them by the total number and get an average point spread. Or I can look at it in terms of, well, if it's truly 80% of the time that we have an expansion the next day, what percent do we expand by? And the average is about 166% of the previous range. So 80% of the time, we're essentially expanding the market by an extra 2/3 of what we did the day before. Okay? And what I've been able to do is come up with a really dynamic process, and I've had a lot of help from people in here to come up with this. And guys, I know the last 3 days haven't been very dead on, but usually, yeah, previous range. But usually, we're on it by a tick. I mean, it's scary sometimes. And obviously when it's like a 65% chance, we don't pay much attention to it. But when it's a 90% chance that we're going to see something, and then the range, you say it's going to be an 8-point range and it comes up 7.75, and we see that day after day after day after day, there's a lot to be said for that. Okay? So every morning what I do is I tell you what the percentages are, and I tell you what my range estimation is. And then what I do is I look at where I see buyers initiating trade, sellers initiating trade, where I see responsive buying and selling. And I look at that and I say, all right, well, if I'm expecting a 10-point range today, and 10 points away from the current low of the day is exactly where I'd be looking to short, does that mean that I'm just going to jump into the short? Or does that mean, wow, I just got some pretty good confirmation. I've got some things that are converging together. Okay? No, total range. And I actually use an average true range. Not an average true range, I use a true range, meaning I account for gaps. I don't know, Mike, because to me fibs are a little out there for me. I've never done any data mining to analyze how often any particular thing works. But this is something that I can take hard numbers on, right? This is just pure statistics. I'm sure that you could do pure statistics on fibs, but I don't know the answer. You know, this I can tell you that 95% of the time after the widest range in 4 days, we have a contraction, and it's usually about 58% of the previous day's range. Okay. No, total, Steve, total range. Okay? And I actually use, the formula that I use is, yeah, I mean, I update mine every single day. Okay, this is something that I do every single day. Okay, every day, that's how I start my day. But what I do for you guys is post that information for you. You know, if you choose to go through the process of doing all the data mining yourself, and you want to use the regular session range, and you know, this is what I use and what I think works. You don't have to swear off on it. Okay. And like I said, I taught a class in this over Christmas, and you know, it's something that, to me, I don't see the value in anybody else doing it. And what we're hopefully planning to do is add a database to the website where each day when you log in and you can see the pivots on there, it'll also show you the percent and the calculated range. But if it's something that you're interested in doing. Yeah, what I look at, Brad, is the last 200 days. 200 days are what form my data set. Okay. Anyway, this allows us to come up with very specific range estimations, and we're not always right, okay? But it's scary how often we are, and we don't just trade in a range estimation like that's the law. We're obviously giving you a tool here that you can use in conjunction with the rest of the chart structure concepts we're showing you today. Now, I realize that many of you come from a background of a lot of different trading courses, and a lot of different books, and a lot of different software, and a lot of different seminars, and a lot of different this and that. And I know that it's a big, tall request to tell you to leave all of that behind, at least for a little while. That can be frustrating. You've spent thousands of dollars on stuff, and you want to believe that it works. And you know what? I'm sure a lot of it does. If somebody was able to properly teach you how to implement it, you'd probably be successful with it, unless it's just total garbage. And if either way, but here you are. Okay? Here you are, all the same, for whatever your background is and everything else. And I feel like just this week alone, I've taught you an awful lot so far. So I'm asking you to have just a little bit of faith. Okay? A little bit of faith. And that's all I can ask for, is a little bit. Because in the end, we have to prove this to you. This has to be something that you can get your hands around. But for right now, I ask that you try and push the other things that you may use and feel are very valuable aside. Okay? Not because they're garbage, not because they don't work, but because you're here and you're here to learn. And the best thing that we can do is get you 100% familiar with this, and then you can look at the things that you have utilized in the past with some success, maybe great success, maybe no success, and you can say, how can I combine these two things? Right? But what you can't do is look at another indicator all day long and say, okay, I'm going to compare this to this, and I don't really understand order flow yet, but mine's going off, and blah, and back and forth, and it'll kill you. This will be done. You might as well, you could have taken the money to Vegas and had a lot more fun with it. Okay? We have to be committed to this process to teach you this and get you very comfortable with it. And I believe through a lot of experience of doing this, we've come up with a really great way for you to get on top of this information. Right? You're hit with a lot of information fast, but tomorrow we're going to go through what we have to do to get you from the novice beginner of this to the next level, to the next level, to the next level. Okay? So I encourage you to push that stuff aside for the time being, and when the time's right, I want you to be able to integrate those things that you utilize and find out where they fit. But I'm going to preface this by saying technical trading levels are extremely low percentage trades. Period. Technical analysis is low percentage. Period. I hate to burst the bubble on that, because I know what everybody reads and what they want and what they expect, and my gosh, my computer and my software and my neatness, right? But at the end of the day, it's very low percentage. Very low percentage. If you're not getting in the 80%, you can't pay the broker. Right? It just doesn't work out. This is not I just have to be right 51% of the time. And not to mention everything else that goes along with that psychologically. But you can drastically improve the performance of any technical analysis that you're using by simply doing the things that we've talked about today. Look at your charts. Look at a 30-minute chart for the last week and say, what's happened? How many ranges have we traded? How close are we to the last range? Where's the last place that there was a responsive buyer or seller? Where's the last place that the buyers initiated trade and broke this market out? Can I associate any of the garbage? And I'm going to give you a very basic example. I am not a fan of high-low close divided by 3 pivot points. You guys hear me bag on it all the time. I can't stand something as silly as that being law for somebody. You go to these websites and they're like, we're going to give you a free pivot calculator. Great, thanks. What am I, a moron? I don't know how to do that? Add three numbers together and divide it by 3? Right? What does that tell me? Anything? Is that where trade was initiated? Is that where the buyers came in and drove the market up? I mean, it's just like a ridiculous number that somebody came up with. And the response when I say that is, yeah, but they work. Right? They work. If I use the weekly and the daily and the monthly, and I combine all of those and they're close together, then they work. Really? How much? How often? Give me some sort of statistic on that, because every time I've ever seen them, they either work or they don't. Right? And it's not even in the 50-50. Okay? But if I take something like a pivot point, where I know that there's going to be a lot of traders watching something like that. Right? I mean, it's like in the last 5 or 10 years, no, not 10 years, in the last 5 years, the amount of pivot point stuff that I've seen out there is just blows me away. Okay? But if you will take something as arbitrary as that you know there's got to be a lot of focus on, and somebody made a comment about fibs a minute ago. You know, same kind of thing. How do you justify the math to have any sort of market sentiment? Only thing you can assume is, well, maybe there's a lot of people looking at it. Okay, but if I take a pivot point, like a high-low close divided by 3, and I put it on a chart and I go, well, son of a gun, that's exactly where yesterday a tremendous amount of buying volume was initiated, and that's what right where there was a drive up in the market. Okay, well, wow, I've just made a justification for something. Not only do I feel that a lot of people might be looking at that level, I feel a lot of smart traders might be looking at that level too. Can you kind of see why maybe sometimes they work and maybe they don't? If it's right in the middle of, you know, no man's land where there's been no trade and no volume, it's going to get run right through, because there's no intelligent trader in the world that's looking at it. But if suddenly I can look at something that I believe to be a godsend because it's a technical calculation, and I say, okay, where does it fall? It falls right where I want it? Great. And Brad, I'd say the moon phase is exactly the same way. So, when I look at technical analysis, first off, I like to do any analysis that I'm doing, I like to do the night before or the morning before I'm trading. I don't like to try and integrate technical analysis into what I'm doing in the middle of. I don't like to integrate technical analysis anyways. But that being said, if I can establish several levels of any kind of price valuation technical analysis, pivot points, Fibonacci, market profile, you know, whatever it may be that you're utilizing, or some variation of all of that, convergence, divergence, I have no idea. Okay, I don't have any clue. But if I can come up with price valuation levels, like we did earlier, where we say, this is an area where we saw something happen, right? If I can do that and combine it with chart structure, and then utilize the conditional order entry tool that we have, you're going to have very high success with that. Now, you may not see an awful lot of trades, but the success rate's going to go through the roof, because you're looking at, and think about the logic behind it. Logic, guys, logic. We're looking at where there was previous valuation, okay, where there is now a pattern of trade in the order flow, and where algorithmically speaking we're at the optimum for having everything come together with the responsive seller, the volume increase, the buyer terminating, and the seller initiating trade. Right? Combines a lot of stuff together to give you high probability technical analysis. So there's a place for all of those things that you've bought, and the things that you love, and the things that you want to work, and all of that stuff. There's a place for it, and I will help you any way I can to integrate the things that you know or think you know about the market. I will. I mean, I love to do it, and every now and then I'm surprised by somebody. You know, I'm not a big fan of a lot of this stuff, but somebody will come to me with something, and it correlates very well to what we're doing. You know, and it's not just this is a magic number. It's I've noticed that when I'm looking at this, it correlates very well when there's a responsive selling pattern there. Excellent. We can all use that information. We can't all use information that doesn't have any logic behind it. At least I won't. And if you start to and you see your trading falling apart, you'll know why. Okay? So, a basic, very basic example of this. This is the same range we looked at earlier. Okay? This is a Fibonacci retracement that is drawn from the bottom of it all the way to the top. Lots of key Fibonacci retracement levels out there. People look at the 328, the 618, the 50, the 270, I don't even know them all, right? I don't have a clue. I don't have a clue. Right? But I know that there's some key ones that are out there. So if I just look at this trading range and I utilize some of the things that we've talked about today. For example, I say, how about I look at the volume profile? Okay, I know where there's risk. I know where there's opportunity. Okay? Maybe I don't even go that far. All right? Maybe I don't even go that far. Maybe I don't know anything about volume profile. And I just take a very simplistic approach and say, here are the ranges that we've established. I know that there was responsive buying and responsive selling, and then the buyers initiated enough trade to get through there, and then there was responsive buying and responsive selling and responsive buying. Okay? And I can identify the market transition points on the chart. Basic chart structure, right? Very basic. And then I look at these two Fibonacci levels that are here, and I see where we're trading up above both of them, and I say, well, if these magical Fibonacci levels are so magical, at least they correlate with what I'm looking at. Could I justify looking for longs at either one of those positions, or trying to trade long off the top one, and if it breaks down, trading short down to the other one and utilizing it as a target? Just based on what we've done here today, I don't think that that's all that far-fetched, right? I've given myself some sort of validation for something that otherwise would be absurd, or at least illogical, right? Agree or disagree? Okay, so what if I told you that I was looking at the 50% Fibonacci retracement, because that's my magic number? Would that hold any water based on the analysis that we've just done of basic chart structure? Absolutely not. I don't see any reason to be trying to buy there. I would like to be short right above that, and I'd look for a target down below it, right? So this is out of reality. I have no basis for taking something here. Could it trade right down there and stop? Sure, we see things happen all the time, right? Things happen all the time. But where are the probabilities? That's what I'm interested in. Where are the probabilities based on the things that I've seen, right? Okay. Within the software, if you choose to utilize it, we've got a set of algorithmic pivots that I came up with several years ago. It's a pretty, it took me a long time to develop, and it's a pretty intense process, and I don't share it with anybody, and I apologize for that, but it's proprietary to me, so I make it available to you. It's the only thing that I don't lay out in front of everybody. But I'll tell you about the basics of it. Essentially what we're looking at is the pivot process starts with, you bet, pivot process starts with basically determining the value area of the previous day, meaning where the majority of trade took place, and that will be represented by the orange lines on your software, or on the page that you log in from. All the pivots are there, and it'll say upper value, lower value, I think. And then there's a midpoint, and then right outside of that are the first set of pivots. Okay, and I don't use this as some sort of absolute. If you were paying attention in class today, obviously I put very little emphasis on anything that is simply a mathematical calculation, right? I just don't, you know. But what I'm going to do is look at it, because something like this can tell me very easily whether or not we're trading and we've begun to consolidate, because we're trading essentially within where the majority of trade took place yesterday, or whether or not we're looking at a range expansion because the first set of outer pivots have been taken out. Okay? And I can take that even further with other calculations where I take into consideration previous volume transitions, previous ranges going back as far as 15 days, and looking at the probable range projections that we use. Okay? So all I'm doing is laying out there and saying, here's a big roadmap. Now it's your job to figure out if any of these make sense. Right? So if I look at my pivots in the morning, I'm not going to just say, well, that means I'm going short here, and I'm going short here, and I'm going long here, and long here. That's not how I look at this type of information. I'm going to look at these numbers, and I'm going to say, all right, first thing that I want to do is I want to go back and look at the previous ranges that we've traded. Okay? I want to go back and I want to see, where are we? Yesterday, did we create a new range, or are we still trading in the same range? Where was the previous buyers initiating trade? Where is the previous area where there was responsive selling? And when I can go back and look at my chart from days ago and see that the pivot happens to fall right where the responsive seller came in, this is now going to be of interest to me. Okay? And if this one happens to fall where there was no activity, then it's not of interest to me. Okay? And then what I can do is say, well, today I'm projecting that there's an 11-point range. Okay? And so far today's low is right here. And this pivot is 11 points from the low. And we're trading here. I think it's going to go there. Right? So what it's meant to be is just no different than any other technical analysis for you. Okay? In that it's very low probability unless you are going to combine this with something that makes logical sense. Yeah, those are the pivots that are in. There should be 13 numbers. There's a value area, which is the two orange lines on the software, but they're noted. There's a center line, and then there's a set of pivots that start right outside. Those are all calculated from the previous day, and then the rest of them are calculated from different range distributions. Okay, and it basically provides you with a symmetrical spectrum where we would be looking for trade. And not any one of them is what you would say, this is the support line, or this is the resistance line, and it's got to stop here, right? That's not what we're looking for. It is a way, just like the high volume mark is a way for you to train your eye to something. These are the first places I want you to check in the morning after you do your basic analysis. And tomorrow, that's what we're going to talk about. We have a lot to talk about tomorrow, because we've got to get you to the point where you can do the morning analysis yourself. Okay? Well, you have to be able to take the information I gave you today and say, where is the major support and resistance? Where are the responsive buyers, responsive sellers? Where did buyers initiate trade? Where did sellers initiate trade? How do we put this picture together so that we can put the puzzle together? All right? And we're gonna work on that tomorrow. We're also going to talk about the opening range, which is the most critical time for you to be paying attention. And trading it is not the same as trading everything else. If you guys have noticed, in the morning when the market opens, I'm not as much keyed into some of the bigger textbook patterns. There's specific things I'm looking for. Settlement. I'm looking for the early, who gets stuck early. Quick breakouts, quick moves, because the participants that are active at the very beginning of the open in the morning are different than the ones that are active 30 minutes later trying to short the highs. Okay? We're also going to talk about critical trading times during the day, and then the most important piece of the puzzle, a plan. Okay? You will have done all this work this week. You will have tried to absorb all of this information, and if you're not going to lay out a strategy and a plan that you can attack systematically every single day, short-term goals, long-term goals, everything, if it's not there together, this has been a worthless experience for you. I hope you've learned a little bit about order flow, but it's not going to make you a success. We have to get you on a plan, something that works for you, something that meets your risk to reward, something that meets your profit expectations. By now you've noticed huge difference in the trading that goes on between myself and 5 or 6 other people that are in the room that post constantly. Right? Some people looking for a little bit here and there, some people looking for bigger trades, some people taking every trade, some people not. You know, how do we get you to that point where you don't just feel like you're lost in a room? I don't want you to be lost here. I want you to be comfortable here. This is supposed to be an environment for you to grow in. But if you don't know what you're trying to grow into, we're not going to get you there. And it's not going to do you any good at all to say, well, all I'm going to do is do exactly what he does. Right? That's not formulating a career. What if he dies? It's not going to do you any good. So if you're serious about this, you need to approach it with a discipline and a plan. And that, my friends, is what makes you a successful trader. Consistency, confidence, all of the elements that you feel like you've been missing, you know? All of those things. That's where it all comes together. All right, guys, let me know if there are any questions.